Alrighty, hey everybody. Let me just see if my mic is working okay. We are. All right, everybody. We should be good to go. Today we're just going to be talking about the majority. Basically, we're going to be talking about the federal rate hike, guys. That's pretty much all we're going to be talking about. We'll be looking at coins here and there, maybe some other stuff as it comes up. But the majority of what we're going to be talking about is just what's going on with Jerome Powell, what's going to be the federal rate hike, and how bad the market reacts to actually seeing maybe a 75 basis point hike, 100 basis point hike, 125 basis point hike, or maybe somewhere in the 50 range or 25 range. You know, consensus is around 75 basis points, but you never know with Jerome Powell. He may go up, he may go lower. We'll have to kind of watch this live in about 45 minutes or so. Okay, buddy? And before I get started here, guys, hey Dynasty, hey Pablo, hey Kevin again, and yes, I will have him live. You guys can see this right here. I have it on the screen right there. Now, what I'm going to do is hide this very fast, but it is ready to go when he does start talking. So you'll see him on the right-hand side of your screen, and then you guys will also be watching. Like, you know, the seconds chart or the minutes charts, kind of watching the live flow of what's going on at the time with every word that he says during his speech, and then what he's going to be talking about when it comes down to, you know, him answering questions from the media, who tend to try to get a reaction out of the market with their questions, right? That's all they try to do, is get the market to move based off of their questions, because it means that they got him to say something he normally wouldn't want to say. Okay, but hey, little cola, hey, low roller scratcher, excuse me. Hey, Kevin again, Crypt, Yellow Vest, happy to see you again. Hope you're doing well. And hey, Ken, happy to see you back, my man. And let's see. Hey, Kevin, when does it start? No, it starts in 45 minutes. 45 minutes, we will have it. And then half an hour after that, we will have his speech. So it's going to be a while before anything goes on. I just wanted to be on live ahead of time, because I think it was going to be, like, you know, important that we kind of start talking about stuff beforehand, and you guys just have an idea of what to expect as the market gets a little bit more volatile. Why is my thing saying no data here? Hope everything's okay on my end over here. Okay, sweet. Sorry guys, every once in a while YouTube does some weird stuff, and I want to make sure the stream is in good quality here. And hey, Far From Broke, what's right here? See, thanks 50 of us, I appreciate it. What's right there? So hey, Rip Sergeant, Dolphin, make sure I'm not missing anybody. Island Time and RW, guys. Hey, welcome back everybody. It's gonna be a fun day today, guys. We're talking about a whole bunch of stuff, and as you guys can see, before I start, you know, answering some of you guys' questions and stuff, try to get most of your questions around the Federal Reserve or the economy today. I won't be looking as much as like all these types of coins or all these types of stocks, just because this is kind of a big day here. Also, Loki says hello, and then he dove away hiding, but he did say hello. All right, but going back over here to the charts, we are still holding this 2-to-1 Ganfin level that we talked about a little bit over the past few weeks. This is the daily chart for Bitcoin, just in case you guys are wondering, because I know it can kind of look a little bit weird. But what I've been noticing here is, as far as these 45-degree angle lines for the Ganfins, they've been much more reliable than the negative 45-degree angles. And, you know, as far as negative 45-degree angles and 45-degree angles, basically a negative 45-degree angle is going down. So that means we're using the highs of 69,000 to kind of make those levels, along with the other dips. But for the 45-degree angles, we're using old lows, and it seems like those old lows are helping us out, especially with these support levels. I will say that the Ganfins are working from the negative 45-degree angle, working pretty well as far as the beginning of the year. They seem to have been getting more less reliable, I guess you would say. Still reliable, but less. I mean, a good example of this is actually when we did have our first initial crash, we actually did stop here. We had a nice bounce back up. That bounce back up, if you actually bought the Ganfin line, was 12%. So it was a good one, but you can see how, you know, it only took a couple days for us to really crash down below. Then we found a little bit of support. We broke down below it again, kind of bouncing around. On this one, we haven't closed down below it yet, but this is a pretty big move. You guys will remember that if you guys are going to be doing some longer form trades right now, this just kind of goes into some trading atmosphere here, or trading talk. Be careful of the daily charts breaking down. I think it's really imperative the weekly charts break down. That usually will symbolize the bad move, right? We broke down here, but we closed on the daily, but we didn't close on the week. And you can see the effect of just closing down on the weekly chart here, or below the Fibonacci circles on the weekly chart here, okay? And so far, we're still holding. That's a good sign, guys. We do not want to break down below this 2-to-1 Ganfin level, because then that's where, you know, on the weekly chart, if we close below it, it's most likely going to be a week where we go below 18,000. And you start to have everybody freak out all over again. And we haven't had a true freak out moment since, like June, early June. I don't know if people are ready for another one so soon, even though it has been a couple months, right? Now, going over a few different things here, if you guys are looking at Bitcoin, here's the daily chart again without all the other long-term cluster stuff. We're still consolidating here, everybody. We still have an opportunity to break out over the next few weeks. It's not a strong chance. You guys know this. You guys know about the death cross, everything else going on in the market. In case you guys are new to the stream, first time ever that we've had the 20-week moving average cross down below the 200 moving average on the weekly charts. Historically, anytime we actually do have one of these death crosses, bad things tend to happen, just really, really bad things. One source of relief here, well, actually a couple sources of relief here, I would say, is the fact that this is the first time the 20-week moving average is crossed down below the 200. So it's not going to have the same effect that we always know is going to happen with the 20 and the 50, 2050 crash, 2050 crash, 2050 crash, 2050 crash, right? We don't know how bad this will be. It is a bearish indicator, but at least we don't have a history of it causing major crashes. We have a history of death crosses on the weekly chart causing crashes because all we normally have is the 20 and the 50 to look at. But again, we'll be paying attention to this very closely over the next few weeks, okay? Now, one other thing before we start going into the dollar index here, which will get interesting because not only is the stock market up, not only is the crypto market up, the dollar index is just skyrocketing right now, and it's just not a good look for anybody because that normally you want to see the dollar index come down if you're seeing all these asset classes raise up. But here we go back to the weekly chart just very fast. A couple things you need to keep track of. Let me just verify that these are all chart. Okay. We still are. Let's look at it now. Get my little neck pillow back in order. We still are about 6% away from that 200 weekly moving average. We're still in a decent spot here, guys. It's not like we're in freak out mode just yet. The moment we come into contact with this line, that's where we start freaking out a little bit because it means one of two things. We're automatically just going to crash off of this bounce and then come down, right, and for a nasty move. Or if we're lucky, it'll kind of follow that basic standard of where whenever we do have a bear market, we do crash below this 200 weekly moving average, we come into contact with it and then bounce. Looking at 2008, what I really hope is going to happen here, to be honest, is that we didn't tap on it here in the past. We didn't break down below it a few days ago, even come into contact with it a few weeks ago. Excuse me. So maybe even with these higher interest rates, we just bounce and then we at least have some time here that's generated before we make a larger move down. History says if we touch it, we're eventually going to break down. Let's see how that works. That may be more of a recession. But if we do bounce off of it and we start looking, if we start looking a little bit more positive, we might actually have a few months of Bitcoin going green and then another large fake out coming where eventually we crash, but we may crash in 2023 instead of, sometime this year. Unless Bitcoin really just wants to go to 16,000 before it has a big reversal. But there is another opportunity here coming up, everybody, where we could have a few months, hopefully a few months of, Bitcoin just doing a whole bunch of nothing, a rally, but, at the end of the day, it all kind of negates itself. My fear here is, again, we want this side where we just kind of bounce and then we have a nice move, right? That's a pretty solid move for the NASDAQ. What we don't want to have happen is this bounce and then a just complete crash really fast where we're only bouncing for like a month or two, and not having more than 2.5 months to really enjoy some really solid gains coming from the crypto markets and the stock markets if you guys want to be trading some of those. So we're going to keep a close eye on it, but we're still like 6.5% away, everybody. We're still, I think, in a solid spot where, you're worried, you're concerned, but you're not in full on panic mode, right? One other thing here though, guys, what is this? This is a weekly chart. I'm gonna go over here. We can go to the weekly chart. Last week, the NASDAQ did drop in value by about like 6%, or at least we're not doing that again, okay? Now, let me make sure I'm not missing any of you guys' questions and stuff like that. Let's see. Seems like the market will dump eventually, but kind of expecting it to run up and then a big dump. Actually, yeah, Kevin kind of talked to my point right there. And hey, Square Bagels, happy to see you back, my man. Which rate will probably cause a pump and which will be a dump? Anything under 75 will probably cause a pump. Anything 75 and 75 may be more neutral because I think it's priced in. will probably still go down actually, but not like a big dump. 100 basis points dump, 125 basis points mega dump. You know, probably going to be 75. Jerome Powell isn't really doing a good job of getting ahead of inflation. He's just kind of managing it, leading to a period of stagflation that we're kind of feeling right now. But to Jerome Powell's credit here, to be, you know, frank, remember guys, there's only so much he can do when it comes to supply. He's trying to hamper down demand, but the majority of the work that has to be done by the Transportation Secretary, Pete Buttigieg, of getting the supply chains fixed up, businesses getting their own supply chains fixed up, and then of course, you know, executive level, White House, you know, presidents, vice presidents, all this office staff in Congress to really get this thing figured out. Jerome Powell only has so much power he can do right now because of how everything's kind of been combobulated, if you will. This is not a normal inflationary part, you know, cycle. This is kind of like a huge government made cycle. And, you know, there's not much Jerome Powell can do at this point besides trying to stop people from buying. Now, to kind of have a little bit of a recap here, this is a monthly chart of the dollar index. We want to see this bad boy go higher. We really do. If you guys want some cheaper Bitcoin prices, if you guys want to see Bitcoin bottom out, you want to see this thing find a top. But guys, I mean, okay, let's talk about this in a few different cycles, because we've been pretty spot on as a channel talking about this over the past few months. Can you guys remember when we were talking about this and how everybody said this was going to be the start of a new bull market? But we were like, nah, guys, you know, we're most likely going to just pop through this like a cork. And then, you know, it did. And a lot of you guys agree with me on this. And a lot of you guys made some good money if you guys took some shorts around this time before Bitcoin. Because you guys remember, June is right here when we had the market bottom. We were talking about this all the way back in April. So good job for a lot of you guys. You guys showed me some profits, and I was really impressed by those. Okay. So here's what's going on, everybody. We did manage to break out above this resistance level here. You guys will go back in to the daily chart. You guys will remember that every time we tried to break out over the past few cycles, no, I guess it was maybe the 15-minute chart on this, we basically kept on getting dumped and dumped and dumped. And then when we finally managed to break out, we really started ripping, and, you know, here we are now at the highest level of the year. We are still going up here quite a bit, guys. And to kind of have a little bit of context of this, we haven't been this high. Let me just make a 2-month chart so we can kind of squeeze everything on one chart. So this is a 2-month chart of the dollar index. We haven't been this high since May of 2002. We're at 20-year highs for the dollar. And just to kind of give you guys some perspective again, we go over here to the watch list. And let me just do one little quick check, everybody. CNBC, they're talking about signs of a slowdown, but I'll let you guys know when Jerome Powell comes out so we can actually watch them together. You know, I just lost my train of thought, guys. Sorry. Put this into perspective here. Let's go over to the daily chart. Let's go to auto, and let's go to the pound, the euro. The euro is less than 99 cents, less than 99 cents against the dollar. A few weeks ago, a few months ago, we were talking about, oh my gosh, you know, we're now at parity. We're now at $1 for one equals 1 euro. Now we're kind of to the point where $1 or 1 euro only equals about 0.986 cents. So not even 99 cents. And with the rate hikes coming in, you'll most likely see this bomb down over the next few weeks to 97 cents, which is absolutely insane. So if you guys want to go traveling to Europe, this is like the best time ever to travel to Europe. If you guys want to take that journey, I've had a few friends go there this year. The pound, guess what? It's still coming back down. The pound is now worth $1.13. And just so you guys can, again, see this just a little bit more, let's go back to that 2-month chart. So every candle represents 2 months. You can really see how far we've fallen. I can even go to the monthly chart here. You can see how far we've fallen. And we talked about this a while ago. When we did break down below the support level, we really came down hard here. But again, the euro hasn't been this low since 2002. This is going to be a big problem for the European countries. However, if you're looking at least at the dollar index here, you know, we may be getting close to a bottom sometime. This is a 2-month chart. So let me go to the weekly chart here. Sometime at the end of October, which means maybe if we are going to have a big dump, it might happen towards the end of this month, closer to October, and then we can start bouncing up here. I would have to double check the pound though against it. The pound might have to fall down a little bit more, so maybe it is going to be sometime in October where we find out. No, what's this? yeah, towards the end of October, beginning of November, we might actually have a bottoming out around there. We might still go down lower than that in the future, but guys, we can't just keep on going down like this over and over and over again. The economy's bad. I can see it getting a lot worse, but it's not like we're in the worst cycle right now, or like the worst of anything right now. Things are getting worse, but we're not we're not the sky is falling just yet. When you see the sky is falling, that's when everybody starts saying, okay, we're getting close to this market cycle. We may just be heading for another bear market rally here over the probably maybe in November we can start it, maybe sometime in the middle of October. But we're getting close to at least some support levels here for some of these Fibonacci levels. And what you guys might also want to do, if you guys do like to look into this type of stuff here, depends on which one you guys are going to do. There's a few different Fibonacci extension levels you guys could look at. This one we stopped for like a half a second basically, and then we started powering above it. I don't think we're going to get up to 135. That'd be pretty crazy. But let me see if I can find another one for us. Maybe low, high, low. Let's start off with that one first. A little bit there. That one matched up. I mean, I guess realistically, we could get up to 117 if we do have to continue raising rate hikes. And that kind of matches up with the highs we experienced in 2002. So, maybe we are getting closer to the bottom here over the next few months. We just have to hope that the recession doesn't really hurt us too much from the stock perspective and the crypto market perspective. But you guys know that usually by the time the stock market catches up to how bad everything is, things are usually getting a little bit better, or maybe the reverse, actually, I would say for that one. But there is one level you guys may look at around 117 if you guys want to play off of a potential top for the dollar index. And the last one here that I'll do for you guys is this one's going to be a little bit more interesting because I haven't actually done this one before. There we go. Oh, this one kind of works out. Okay. Some resistance there, a little bit of resistance there, a little bit of resistance there. Oh, yeah. Maybe around 116. Maybe we actually find a nice high around there. That'd be pretty nice. And again, we're using a monthly chart. So we're looking at like years of data here, going from 2022 all the way back to 2010, even further back. But we might be able to see that next big reversal happen somewhere around 116. I'll keep you guys notified of this, but it seems like 116, 117 seems like a reasonable range if you guys want to start saying, hey, at least we're going to find a short-term top where we can start slowing down a little bit. That'll be a good opportunity. And what I mean by that here is if we go over here to the daily chart. All right. Once you see this little part right here, I'm going to kind of make this up as I go along here because I want to see if it's actually accurate or not. But you see right around here, around, I guess, what was it? When we actually hit that level of resistance, I guess, yeah, we broke up about it. Yeah. Okay. So right here as well. So let's say around, May. Let's see, come back down. Where did we actually break out above it? No, we're still moving up here, guys. Yeah, never mind. Forget what I was just saying. Stick with those Fibonacci levels. I was just hoping to see, thinking about some data as far as Bitcoin, but it's not going to work out in my head. I was thinking like May 13th, what happened between May 13th and May 30th. If we go over here to Bitcoin daily chart, May 13th to May 30th. Oh, we did actually go up. Okay, we actually held while that dip was occurring. Never mind. Yeah, it's okay. So yeah, you at least see a little bit of stability when we hit these levels of resistance. That's actually good to know. I was remembering what happened in May, and this was kind of in my head, and I was like, we didn't really have a good May. It was so choppy and ugly, but at least it wasn't crashing like it did, closer to June 8th. And what happened June 8th, I guess, from here? Oh yeah, June 8th, we just rocketed. So yeah. But we are rocketing up right now and the whole market's going up, which is kind of a weird thing to be looking at. But okay, everybody, let's just do one more check here. The main goal, I think, for this week, before I start answering you guys' questions and we start talking a little bit more in depth about the Federal Reserve, we want to stay above this 2-to-1 Gann-Fenn level. For those of you guys that don't know, this 2-to-1 Gann-Fenn level that we're looking at, it starts off all the way over here from the COVID lows. We also have 2-to-1 Gann-Fenn levels going all the way back over here to 2015. Nice. We're not coming into contact with those just yet, but so far the method I'm going to be using for some of these potential drops or potential crashes that we're looking at is mostly going to be, I want to trade the clusters. If you guys are new to the channel or you guys haven't been here for a hot minute because the market's been kind of boring, I put on like a whole bunch of Fibonacci support levels onto these charts, like 10 or 12 of them, and whenever they have a tight cluster of support with a whole bunch of lines pretty much like overlapping, I just put a red rectangle there, and whenever you buy, like the first time during a crash the market actually hits one of those levels, you want to start buying, and then a few days later you can sell. So sometimes it might be a day later, sometimes it might be a week later. You're usually going to have a good opportunity. If you buy during this crash anywhere in here, let's just say you bought the top of the crash, a couple days later you're walking with like 17%. Even if you only wait 24 hours, you're still walking with 10%. Over here, if you buy, let's just say in the middle zone, you know, you wait a little bit, you're up like 29%. Just a few days later, you're at least up about 5%, depending on how you guys want to, you know, be trading this. Last time as well, let's say you got the middle, a few days later, 14%. The last one that we experienced in June, you buy right here at the top. A few days later, you're up like 22%. If you held on a little bit more than that, you definitely walked away with some good profit. The next level of support that we have, excuse me, I can move this over right now. It's going to be actually down here around $15,000, which isn't the best. The good thing for us is we do actually have some GANFAN supports kind of around 15,700 before we actually take that move down. So you might even see something more of a crash and a bounce than the next move down. And then once we get closer to this, like, you know, $14,000, $15,000 range, that's where I could see us having a reversal and then trying to climb back up, you know, over the next few weeks and months. But again, we don't know when this crash is actually going to happen. It may happen sometime this week. It probably will happen more likely in October if things, you know, don't get better, I guess, or get worse, too much worse besides rate hikes. So keeping all this into perspective. All right, but let me go over here. What's that support level? I need to update this chart as well. Let's go horizontal, vertical, and let's make that right there. And that way you guys can see, I think you guys can, yeah. Let me open 17,622. Let me open up the settings here. And let's go to maybe 28 so you guys can see it a little bit better. Yeah, that a little bit better. Just in case any of you guys have bad eyes. Everything on my screen is small because I'm using all my monitors right now. Okay, but there we go. And then we got the second chart here for Bitcoin. This is going to be a pretty fun day, everybody. There is going to be some really volatile moments in the market. If you guys are not like really good at day trading, or the data says you guys aren't very good at day trading, it might just be worth it to watch and chill out. If you guys do want to do some day trading, go for it. Just be careful with leverage, because sometimes when we have very volatile moves in the leverage in the crypto markets, margins kind of get skewed and some people get kicked out or the stop loss hit just because of how volatile it is. And it's not to do with that you know your trade is going in the wrong direction. It's that your margin percentage gets so large because of the amount of money they have to keep on loaning you, which is very complicated. But just be careful with it. A lot of indexes or exchanges have this problem. All right, now let me see what I can find out as far as CNBC is concerned. Rates on the rise, how to position. Okay, they're still not talking about the Jerome Powell coming out anytime soon. I think looks like we still have like 23 minutes until the announcement is made. And then from there on out, we're probably going to have to wait 15 or 30 minutes before Jerome Powell actually talks about anything important here. Okay, guys? Or he comes out to do his press conference. Let's see. Let's see. And hey, Courier G, yeah, I still have all my long-term positions, everybody. I still have all the long-term positions. Let's see. And hey, Square Bagels, should I queue up the Jerome Powell speech on another device, or are you going to be playing it live on your team? Oh, yeah, Square Bagels, I'll be playing it live. I just can't play it live right now because it's, because I can only play it for so long before YouTube gets irritated with me. So I'm going to be saving that time basically for Jerome Powell talking. I'll talk over him a little bit every now and again when he's answering questions. That's just to make sure that YouTube doesn't feel like I'm taking like CNBC's product for myself, if that makes sense. All right. And hey, Slime behind me, I see volatility. Sorry, took me a second to realize what you're talking about. It's high right now. How do you avoid IV crush on a day like today? You don't. There's no escaping it. What you have to do instead is you just have to be in the market for such a small amount of time. So, you know, what's basically happening during, in part when you have implied volatility, is it's better if you do a day trade during it instead of a long-term trade off of it. Because what's happening is there's so many more people trading SPY, buying it, selling it, buying puts, so to speak, that what's going on there is the prices are all getting inflated. Just like we have a bid and an ask when it comes to the crypto markets or the stock market, right? We have here, we have a bid and then we have an ask, and then you're trying to get as close to the bid as possible so you get the cheapest price. Well, on days where there's a very high, implied volatility and there's a lot of people trading, that bid and ask is inflated higher than it normally would be. So you're actually paying more, but you're also you're able to sell it off for more as well. So if you're day trading, you're still going to be working within that range. The problem with it is when you get closer to, like a week from then, expiration and everything like that, less people are more actively trading those particular calls and puts. So, and with theta, the market normally is just coming down already. So you see a bid come down slowly if the market, if it's not really doing anything at all. You see the ask come down slowly. But with implied volatility, they just start coming down even more and even more. So, for now, if you're doing day trades or you're doing a 1 day trade or something like that, you're going to be fairly okay. But if you're trying to make a trade today, at least in this high implied volatility scenario with the SPY only, because that's all we're talking about, that's where you have to be more careful, because if it's not going in either direction, the losses will exceed your expectations. All right, you'll lose value a lot more quickly. However, if it's working in your favor, people are most likely going to be trading it. You should still see your ask go up. You should still see your profits go up. Everything should be fine. Depending on how fast it moves up, though, you may not see it move up as fast as you might expect. And what I mean by that is maybe one day, if you buy a call today and the SPY is going up, but it's only going up by a little bit, you may actually see the price of your options decrease, even though the price of the SPY is going up. So just be careful with implied volatility. But I think if you're doing a little bit of a day trading or even a 1 day trade, you should be okay at this point in time. Hopefully that made sense. But, no matter what happens right now, the market is going to be inflated. It's just going to be inflated for a lot of these assets that everybody's trading. So like 19 minutes and 48 seconds until the Federal Reserve releases their statement. Okay, let me go over here very fast. What I'm going to do for you guys, if I can find it again, I haven't used it in a minute because I haven't done any options work for a second here. Let's see. There we go. All right. So, okay, 300%, maybe a little bit too much here. Here is live option flow data. Some of you guys know what it is. Some of you guys don't. This is basically me being able to look at what the hedge funds are buying and wealthy individuals are buying in the options market. As you guys can see, maybe you guys can't actually, you guys can't see it all the way because my top tickers are kind of blocking it. But 666,000 calls have been bought today, or traded, not bought, and 500,000 puts have been traded today. And so if we want to go over here to the SPY, we're looking at buy flow actually right now. So everything is going to be traded at the ask. You see this little A right here, that's at the ask. In the last few minutes, a lot of stuff has actually been puts. There has been calls though today. So, a few minutes ago, some calls over here. You're going to see a lot of leveraging today, or hedging, not leveraging, excuse me, hedging today. Where they're going to be hedging their bets. But I'm looking right now and they're doing sweeps. There's a lot of, basically a sweep means they're going through any exchange and all exchange to buy as many calls as they want to. They don't want to buy all of them from one exchange because there's probably not enough for them to buy. So they're trying to go as far as they can for it. So what you're going to be looking at here is, let's go over here. I want to kind of filter this down just a little bit. Oh gosh, I haven't used this in a hot minute. But let me change the filter. Toggle advanced filter. All right, maybe it's not going to work for me to kind of go off of the filter. The guy just did a massive update with the website. It looks, I tested it out a few days ago, but I have not actually tried to use the advanced filter here. Come on, advanced filter, work. Maybe I can just do, oh yeah, see, yeah, update summary, 17th of September, yeah. Do I got to do anything here? Let's see. Oh my gosh, that's a freaking massive update. There we go. Okay. Just had to refresh the page. It might have something to do with my ad blocker. So we don't need to look at dark pool data right now. I think all we're going to be looking for is at ask, above the ask, and then we're going to be looking for over a million. Nothing over a million. Ask, above ask. So nobody's taking any massive positions. Let's go to highlighted flow, 1 million. Okay, we can go with that one. Oh, no. Aggressive orders. No, not much. Okay. Out of the money. Probably what we want to care for now. Okay. So these are all everything out of the money. So they're not hedges, they're not bets. They're just, hey, we want to make a quick buck off of this. And if we go off of premium, the highest amount of premium was bought, what is it? 85, this is Eastern time, I'm assuming 12:30. So this was bought a little bit ago, and let's check out the SPY, guys. Oh, geez, Bitcoin's taken off here a little bit as well. Let's go over to the SPY, though. Last half an hour. Yeah, they bought it right here, and they're probably going to sell it pretty soon, so they managed to actually make a good amount of money here. But to be trading with $1 million, gosh, I mean, it's going to be making them a lot of money, but still. 12:30, yeah, some puts around here as well. It's 12:41. Okay. So I would say that the majority of people out right now are kind of buying puts, it looks like. Right here, early morning. Early morning, a lot of people did calls. And what I'm looking at here is a lot of these are day traders in the hedge fund markets. And so what you might see is them not necessarily holding for multiple days. They're literally just trading in and out. But what you see with the option flow, the way I have it set up, is you're only seeing the buys and not the selling of the assets, which means you're seeing trades made at the ask, because, you know, when you buy, you're usually buying at the ask price. When you're selling at the bid price, right? So you've only seen half the option flow right there at that point in time. Excuse me. Okay. But Bitcoin's trying to make a move here, guys. Just to kind of give you guys a little bit of an idea of what's going on. Bitcoin is up 3.5%. Ethereum is up 4%. Dogecoin's up 1.5%. ADA is up 1.5%. STMX up 2%. Sol up 2.5%. Ethereum Classic up 1%. Matic up 1.5%. So you're seeing some mixed results. XRP is down 4%, but that's just because it had a crazy rally over the past few days. Everything else seems to be a little bit more mixed. EOS is down 4.5%. Filecoin's up 1%. UFO tokens up 1%. Let me take a look at my watch list here for some of the things I'm holding at this moment in time. Let's start off with what's losing the most money over the last 24 hours. HBIS is down. Energy Web token is down here a little bit. So you got some mixed ones. I think the worst is down 8. On the other side, Reef is up 7. Callus Network's up 6. Now, this is the watch list for very, very low market cap coins. Nothing in this is really too high of a market cap. But you can see more mixed results from these lower market cap coins, and I think you would actually see from some of the bigger dogs in the top 100 coins. Let's see. Like SCMX I own quite a bit of, but it's only ranked 289. Let's see. Okay, so you're seeing a more mixed reaction from the altcoin market right now. It looks like, well, yeah, only thing really bustling up right now as far as the larger market caps is Ethereum, and that's because Ethereum has fallen down quite a bit over the past few weeks, right? Apecoin's also making a move. Maybe we could talk about that very fast. Let's go to the 5-minute chart. It's starting to make a little bit of a peak here as well. So keep an eye on this one. Which one is it actually trying to hit though? Oh yeah, got rejected right off of that level, didn't it? But it can still go up a little bit higher. Okie dokie. Make that right there. And hey, Keegan, what's up, Mike? We pumping? Yeah, guys, we pump almost every time going into this announcement. We have about 12 minutes left until we hear the announcement of whether it's 75, 100, 125, 50, or 25 basis points. But the majority of the time, whenever we have these rate hikes, we always run up into the rate hike, and then we either crash or we go boom afterwards. We're probably going to have an initial big move when the announcement is made. After that occurs, we're going to slow down just a little bit, and then Jerome Powell is going to come out, give a short speech like he normally does. After that, the media will be able to ask him questions. Depending on his answers to those questions, and even the statement that he gives out today, that's where we're going to start to see some of the longer term effects of his of what's going to be happening to the market. If he's extremely hawkish, we're probably going to be going down over the next few weeks. If he's kind of more nuanced and mixed, which it seems less likely after his speech in Jackson Hole a few weeks ago, then you would actually expect us to have probably another bear market rally, maybe Bitcoin even going back up towards $25,000. Now, that is a lot less likely than him being more firm, of course. However, Jerome Powell hasn't been doing the best job with inflation because he only has so many tools. But the one tool he does have is his mouth, and he just has not been using that too effectively to give the markets a clear idea of what he's expecting. And it's not totally his fault, guys. It's just that, the market wants the market to go up. Like the hedge funds, the banking system, they all want the market to only go up so they can make more money. They will use any excuse of anything he says to try to get the market to go up. So if Jerome Powell comes out and says the whole market is falling, the whole market is going down, the whole market sucks, whatever. But then, somewhere in the middle of it, he says, even though everything is really, really bad, we still see hope for next year. The market will try to use that as an excuse to go up in these troubled times during, a really bad time. And that's kind of what you saw during the last few months. And remember, guys, going back over to that dollar index and even just the stock market in general, on the 5 minute, it's coming back down a little bit. That's probably why you see Bitcoin popping off here. We had been talking about this for a while. We talked about how, after we had that crash down to $17,000 for Bitcoin and things just really didn't look too good for us. Back over here to let's just go to the daily chart. Forget about those lines for now. It's not going to make much sense because we're on a daily chart. But what did we say? Or what did I say? And I think some of you guys agreed, some of you guys didn't agree, whatever, it's the market. Everybody has their own opinions. I mostly kind of debated this with other YouTubers. I told you guys to watch out because we're probably going to have a rally. And during that rally, you're probably going to see a lot of people on YouTube or TikTok or Twitter, or just influencers in general, which I guess I am one, say that the bear market was over and then we were only going to be going up from here and we would continue on our normal bullish cycle. If you kind of zoom out the NASDAQ or one of the other indexes and you kind of put it on the monthly chart, you'll see that we do have these hiccups, but we kind of just keep on going up, hiccup right here, keep on going up, a little bit of a hiccup right here, keep on going up, hiccup, and then we just kind of keep on going up. But it looks kind of scary at the time, right? Like this is a monthly chart, of course, so everything was kind of squeezed together. But within 3 months over here in 2018, the market fell 23%. And then what did we do? We just picked ourselves up by the bootstraps and the market just kept on going up until COVID. And then we really turned it into overgear with all that stimulus. And, so far since the highs, we fell down about 34%. People want to believe that we are just going to trickle back up here and everything's going to be okay. I'm not of that viewpoint here. You guys know, I think we're probably going to be going down a little bit lower over the next few months and even going into 2023. But you guys have to be prepared for some of those bear market rallies because, even if I believed there was going to be a bear market rally, which, would eventually come back down because I didn't think the economy is going to be that good around this time, which surprisingly it's not. Not surprisingly it's not, excuse me. There still is a good chance to just make money if you buy and hold, right? During those times. So, just because it's a bear market rally doesn't mean you're not going to buy and try to sell, buy low and sell high. You're still going to be doing that. You just, have that added information in the back of your brain saying, hey, scale out when you feel like you've made enough money because the market's most likely going to come back down. Some people scaled out everything. Some people scaled out 75%. Some people only scale out 50 or 25%. Whatever your strategy is, as long as it's working for you, keep it up. And right now, all I'm looking for, they're just talking about the hearings going on in Congress. I was watching that this morning. It was incredibly boring. Jamie Dimon is on fire in there, though. He is just like torching us, senators and stuff, House members. But it looks like we have 8 minutes left until Jerome Powell speaks. I had 7 minutes now, actually. So we're getting closer, guys. 7 minutes until he speaks. I wish I had a timer on my screen that would work for us. Let me see if I can do this right here for you guys. No, we don't need to actually have a timer. I'm fine without it. But yeah. 8 minutes left, everybody. We're getting to crunch time now as far as Jerome Powell giving out the information. And let me see. Questions? Yeah, okay. We still got some time left. Let's see. And hey, Slimy. Thanks, Mike. I'm doing a day trade on SPY. I'm planning on doing a strangle. I'm interested to see how the IV changes affect me. We'll see how it goes. Short term, it shouldn't matter too much to you. Just, hopefully it's not above 150%. Hopefully it's kind of somewhere around there. But as long as you're doing a day trade, you really shouldn't see the effect. You will see a volatility though. So if it drops, it'll drop a lot more. If it goes up, it'll go up a lot more. So it's like options charged. I don't know, options primed, options multiplied, whatever you want to call it. You're just going to see more volatile numbers coming out. I had TD Ameritrade open this morning as I was making a few day trades. And my, oh my, was it just a crazy market. Luckily, I traded Apple, which is just doing a little bit more calm. But here, I wasn't using TradingView. I was using the built-in system of TD Ameritrade, Thinkorswim. But here, let me show you something. Let's see, Apple. Why do I keep on drawing stuff? Extended hours. Okay, you guys might not be able to see this faint stuff right here. Maybe no, it was a 50-minute chart. Which one was it? And then, actually, we don't need to see this right now. I took an options call right here just to see what would happen because I was expecting a run up before. It was mostly a run up play, but basically, I was able to kind of buy right here and sell right here for like a cool 30% profit and just holding for like maybe like 30 minutes or so. It was more when we kind of sealed a fade above the 50 moving average here, but you're going to see some really volatile moves. And right now, what you're looking at actually is kind of ugly as it may look, I guess you would say. You're seeing, I should have traded this earlier probably. It actually just happened a few minutes ago. A shoulder, a head, and another ugly shoulder. It's not even that good of a shoulder. But you're seeing that breakout occur right now, and that's why the market's moving up a little bit higher for Apple. So you're going to be making these very short-term trades, but you're most likely, I mean, for me, I'm only in them for like 15 minutes to an hour. Usually not in them for too long here. Was it? There was another one I was trading too. I don't know what it was. Was it? No, it wasn't Tesla. But yeah, get ready for some volatility. It'll be pretty fun to watch all this stuff play out. At least in the dollar index, you do see the 15-minute chart giving a little bit of a dip here. But yeah, it's just not looking the best. I'm right here. It's time to scalp with leverage in 5 minutes. Let's go. But be aware. Yeah, definitely be aware if you guys are going to be going off of leverage. And hey, baby fish, scam pump. Yeah. What do you call it definitely always pumps up before he does this all the time. It's just a net factor of life. Wow, look at that double bottom right there on the seconds chart. So here. Somebody asked a question. Hey, Yellow Vest, it's going to be a nasty surprise if he does 100 basis points. I think the market's practically right now just basing in 75. Everybody's talking about 75 with the potential for 100. You know, they've done that a few times here, but I guess this is the most likely time ever that he might actually do 100 basis points. What's more likely, Bitcoin 10K or 30K? I mean, probably, depending on how the end of the year works out, we might go to 30K, then dump to 10K sometime in 2023. So we are going to be due for a little bit of a rally here. I'll enjoy that. But I mean, there's still a decent chance, not a good chance, I would say right now, unless the recession really gets priced in as being much worse. There's still a good chance we could hit $10,000 before this bear market is over. It would suck, but you know, it's still, you know, I wouldn't ignore it. And right now we have the Fed decision as imminent. I have everything kind of ready to go on my side. I can show you guys very fast what's going on. There we go. Oh, is it not? It's not actually playing the sound, or I don't know if it is. Video option device. Source settings. Oh, I did video capture device. Oops, sorry. Desktop audio. Okay, so yeah.
About 4 minutes until the news comes out.
So yeah, I'm watching it. When it comes out, I'll be there to turn it right back on for you guys so you guys can see what's actually happening. But it is imminent. They're just having a panel of like 3 people talking. You know how boring the people on CNBC can really be about this type of stuff. But you know, we're watching Bitcoin's price action right here. You have the second chart on the left. Bitcoin's 15-minute chart on the right. We have the dollar index over here. And then what we'll probably actually use instead of looking at ApeCoin right now is probably let's look at the NASDAQ here to see what's going on. So this is the NASDAQ 5-minute chart. We'll see how bad everything ends up turning out to be, or maybe good if he goes to 50 basis points or 25 basis points, if he feels like he can be so bold, right? Let's see. And hey, I'm happy to see you back, man. Hope you're doing well. What's right here? Sometimes when Powell's not happen straight up, we get nasty move. Yeah, I mean, again, he's not the best speaker as far as being consistent. And remember, he's had to build credibility back up, everybody. Jerome Powell has had to build that credibility back up because he was so wrong about transitory. How many times did Jerome Powell and Janet Yellen come out and say, transitory, 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 it's just going to be transitory? And when it wasn't transitory, they just got demolished, right? They just got demolished, and their credibility got demolished along with them. Let's see. Hey, Antony. Yeah, Jerome. So Jerome Powell is going to talk after this number comes out. And then he's going to give a speech, little update basically. And then he's going to take questions from the, oh, here's the pump up beforehand. Then he's going to take questions, from the media. And that's where the market's really going to move, as well as his statement that he gives after the numbers come out. Let's see. And hey, Bideford, welcome back, and hope you're doing very, very well. And I'm happy to be on here today. It's been a nice. Get ready for the big hammer. Gosh, all of you guys are sure that we're going to be coming back down, but just look at this volatility here. This is just crazy volatility. All right, so let me put CNBC on for us. I'll keep the volume not too crazy.
The Fed may go too far and stay there too long and really damage the economy. You seem to have a more nuanced view of that. I've got 45 seconds. Explain why.
Okay. So again, this is there's Bitcoin going. See volatility. So this is why I said be careful if you guys are going to be day trading here. We do have one level of support. Just can back up here very fast. This is an old level of support, so it's not the most important thing I think I'd be paying attention to right now. In fact, I might even just move this here down below if I can find. What is this? Oh, this was an old breakdown point. Okay, we don't need that line then. Let's just do another horizontal. All right. 15 minutes. There's Bitcoin taking a little bit of a hammer right there. And let me do this right here as far as 18232.56. All right. And there we go. Here's the news.
The Federal Reserve raising interest rates by 0.75 of a percentage point.
0.75, predictable.
Range of 3 and 3.25%, the highest rate since early 2008. The Fed saying that ongoing increases will likely be appropriate in the funds rate. The Fed also saying inflation remains elevated. It's sharply raised the median forecast of a Federal Reserve official, sharply raising the outlook for the funds rate for this year to 4.4% from 3.4%, so a full percentage point. By the way, that is a little higher than the market was going into this meeting here. For 2023, the median forecast is for a 4.6% funds rate. Again, a bit higher on the peak rate than where the market was, and that was from 3.8 for 2024.
Okay, he's talking about a whole bunch of just non-important stuff right now. But basically, you're seeing it's a little bit worse than expected. Not the 75 basis point rate hike. And sorry, guys, if I talk louder, I do have his voice also in my ear, even though I turned it off for you guys right now. It's not important what he's talking about right now. But basically, what he's saying is instead of having instead of for the target rate hike going to be somewhere around the 4s, like the low 4s, it's going to be more of the medium and higher 4s now, which means he's going to have to raise interest rates more than before. And that's where the negative, like the bad effect is coming on the market. Okay. You see the notes kind of popping up right now, but it's 75 basis points. I think this is what the market expected. This was pretty predictable. We all kind of, well, I was hoping that he would go up 100 basis points, but he did not. So there's that. But, you know, everything is kind of going along the plan. We talked about how it was going to go up. Babyfish was doing the hammer here a few seconds ago, ready for the hammer. Some of you guys, oh no, GT was saying it too. So now we do have this news out. We do know the interest rates are going to be going up higher. We're going to have more interest rates than expected through this year. That's not going to be good. So you are going to see us most likely over the next few weeks take another leap down. We'll have to see how bad the markets react to this today. But again, there is so much volatility going on right now. Just look at this. I mean, this is the second chart here. So let me just zoom out for a second. You see how wild this got? That's because whales were trading so much that there was just so many walls that just did hard stops, buy, sell. Look at this. This is all whales trading right now. And you're seeing the bid and ask levels just get squeezed down here, leading to some, you know, I mean, we normally don't see them get squeezed this much. It's really fun to watch it. I mean, maybe you guys don't think so, but I love to watch it get squeezed this much. Let's see. There we go. Let's listen to whatever his name is, Sorelli.
3.62%. Fed fund futures, and there's so many contracts. I'm looking at the January. It dropped like a rock down towards 95.66. When its prices go down, the Fed presence goes up, but it's bouncing a little bit, and you are seeing yields very volatile, and I described the way they moved, but they are easing back just a bit. Of course, waiting for Q&A. Ultimately, another dynamic was prevalent right before the announcement. 30-year and 10-year yields were on top of each other. It actually inverted briefly. That's a very unusual inversion, because 30s to 10s, known as the knob spread, since 2006 has only had 2 sessions, and they were both this year, where they closed inverted. You want to pay attention there. And last but certainly not least, the dollar index, certainly the beneficiary of the path the Fed has taken.
All right,
There's the dollar index, guys. Here, we'll pause it here. Pause this for now. When he actually comes out to give a statement, I'll do it. YouTube won't allow me to do too long, be showing you guys the videos for too long, the live streams. But yeah, so look at the dollar index right now. We are definitely skyrocketing right now. And we just launched, guys. Now let's just kind of put this into perspective for the monthly chart. We're now up to 111. That next level of resistance that we're going to be looking at up here right now seems to be around 112, with an opportunity to get way up here like to 117, 115, like we talked about a while ago. But let's go to the 2-month chart here. Oh, let's probably go to the weekly chart. I guess we'll just have to zoom out a little bit more and just kind of scroll. Excuse me. We haven't been this high since June of 2002. Before it was like May or something like that. I don't know. Well, somewhere over here. We've definitely jumped up a little bit more, guys. So we're at 20-year highs. We could also take a quick peek here at the Europeans. Where are we at? Where are the Europeans at? There we go. The euro. Let's go to the 5-minute chart. The euro just dumped against the dollar. So now, you know, $1 euro is worth about 98 cents. That's not good at all. So yeah, that's gonna be interesting. Oh, and the Federal Reserve sees a 4.4 funds rate by year's end, up from 3.4% in June. So that's what we're talking about. They see themselves doing more rate hikes, not less, which means the economy will probably get worse. We're heading more for certain into a recession. This means that 2023 is going to be a rough year for stocks, especially if the data starts coming out that says, hey, our growth is slowing, you know, we're doing worse off, layoffs are coming. These are more of the things you guys are going to hear over the next few months, if they really do have to do more rate hikes because inflation is being a little bit more sticky than they would like to, like to say. Well, they admit it would be kind of sticky. But yeah, the euro is just not in good shape. The pound is really not in good shape. 1 pound equals $1.12. Where if you look at it just a few years ago, you know, 1 pound. Let's go right here. 1 pound at the beginning of this year was worth $1.42. Now it's worth $1.12. You know, the pound to the dollar has lost about 20% of its value. So that means if some guy in England wants to import something from America, it's costing them $20% more to actually make that purchase, right? Because a lot of people have to transfer into American dollars to get that stuff. So they're using their own currency for it. So, which is another reason why we need Bitcoin, we need the blockchain, we need one centralized currency or decentralized currency. If everybody was using Bitcoin, we wouldn't have to worry about how bad the economy in country A was doing or how bad the economy in country B was doing. If we all that one currency that really was like, you know, not causing all this chaos. Now, guys, just a few years ago in 2014, this was, you know, Obama administration coming out of the recovery. Federal Reserve was just going crazy with money printing to kind of keep everything up and up, where we kind of started all this mess at. You know, we were at $1.72. Since 2014, at those last highs that we experienced, the pound has lost about 35 cents against the dollar. So, you know, All right. Let's go back to the 5 for this one. There you go. Keep it up. All right. There you go. And now we can go back over here. And Jerome Powell is still not talking. I will let you guys know when he is talking right now, but he is he's just chilling, waiting to give us a little bit of a speech. All right, there we go. And hey, Cassandra, happy to see you. What's right here? Let's see. And hey, Kilo Charlie, welcome back. I'm laughing in French because we are organized, but it's not funny. The plan continues. What do you call it? We're going to have to see how crazy everything gets, guys, over the next few weeks and months and even years, I guess you would say. But at this point in time, you're seeing a lot of different assets kind of have mixed reactions. So, you know, you see the Bitcoins going down. You can see that pretty clearly. You see the dollar index is obviously shooting up here. And, you know, if we just go through this list very fast, Ethereum looks pretty similar to what Bitcoin's going through right now. Still positive for the day though. Doge pretty similar, ADA pretty similar, STMX pretty similar. You know, is there anything that didn't actually make that larger move? Dogelon didn't make, oh, Dogelon actually didn't make that big of a move compared to a lot of other stuff, but it's low market cap coin. XRP similar, Bitcoin Cash similar. Everything just managed to tank at the same time. Probably something with the algos, of course. But you guys could see that was, you know, that was the big hammer that everybody kept on talking about. This is Luna right here. Took a little bit of a dip as well. Sushi. Everything's coming down. And still not, Jerome Powell still hasn't come out yet. He probably has like another 15? Yeah, it's 5 minutes left. Excellent. So yeah, everything's pretty much taking a big dip here. And what is this? This is old level support. It looks like we don't need the support level then. Let's go over here. There we go. Oh, and we broke down below that support too. That's not good. Oh, well. All right, back to the dollar index. Here's a 5-minute chart. Oh, we may actually just have another big pop here. Hopefully that's not the case. Bitcoin would probably keep on coming down more. Put into perspective what we were talking about over the last few minutes. Nice pump up. And then we really did just get hit hard here. But there's so much volatility going on, everybody. Just be careful if you guys are trying to get into this. You know, you're seeing some small levels get broken down below, but then you're just seeing some really crazy reversals. This is a second chart after all, so you're going to see a lot of that move, that fast movement. But yeah, it's what a show from the markets here today. You're seeing whales go crazy at this point in time. What else right there? Consumer discount is down. Staples is up. Okay, so we're seeing a little bit of reversal, guys, here. See, and hey Prince, we just talked about Doge a couple seconds ago. Like just did a fast little look on it. Nothing's really crazy happening with Doge. It just went down. It came back up just like everything else right here. Definitely pretty volatile though, based off of the news coming out of the Federal Reserve. Let's see. And hello, Lalo, I'm not familiar with that year. And hey Christine, Chili's didn't really tank. Oh, I think that's because it already tanked earlier today. Yeah, it's already down for the day. Came down a little bit. It actually managed to bounce back up. I think just because compared to everything else, it's down quite a bit on the 15-minute chart. Whereas if you look at something like I don't know, Doge, see how it's much more stable, or Ethereum, much more stable. I think it's just because it already fell down enough over the past few hours that it was like, it doesn't really have to go down anymore. Didn't even break down below the lows we experienced earlier this morning, which is actually pretty nice for Chili's. That one's been kind of doing its own thing lately, which has been nice. I like to see a coin be independent. All right, let's go back over here to Bitcoin. Still on the lower side, guys. It's not really coming up as much as you would hope. I'm looking at CNBC on my screen, and it looks like it actually froze. So let me refresh that page. But there we go. So we can get any more pictures coming on now. There we go. Okay. So we do have the big news coming out, everybody, that to kind of sum it up before Jerome Powell comes out. He raised it by 0.75 basis points. It looks like that worked out fine. That was kind of what the majority was expecting. Going over to this poll here, over 200 of you guys voted. 50% said 75, 35% said 1 to 1.25, 9% said 50, and 6% said 25. So the majority was correct in this one. I guess that was the consensus anyway. But you know, you do be careful here as the volatility increases. Now, please, CNBC, work for me. I think everybody is going over here right now to kind of get a look at it. Let's see. Let's see right here. I want to make sure I can find this when it actually comes out. If that one's not going to work, I'm going to go to a different one. Not that one. Maybe that one will work out. Yeah, my other CNBC thing crashed, so this one might have to work out for us for a little bit. Let's play the stream. Oh, wow, yeah. I have a feeling that everybody's trying to stream this right now, and it's causing a little bit of backlog. A fatal error occurred. Okay, I got it on another string here. Oh, and Fed sharply lowers GDP forecast. Okay, if this isn't going to work, let me just do one other thing here, guys. Let's see. Okay, this is going to be annoying, but this is what we're going to have to deal with for now. Hold on one second here, guys. No, it keeps on freezing. I'm not going to give you guys a freezing video. It just doesn't seem right. All right. Let's see. I can hear them talking, so I know it's working. Let's see. There we go. Okay. Yeah, I'll figure it out, guys. He doesn't come out. Well, he's supposed to be coming out now. Hopefully it's not too bad here because that thing keeps on freezing. CNBC. Oh, wait. I have Fox Business as well. So what am I talking about? We don't have to watch CNBC. We can watch anything. Yeah, Fox Business isn't having problems. I guess I'll use that then. Okay. Let's go over here very fast. So I gotta like maneuver this around a little bit. So just give me a minute, everybody. But there we go. All right, there we go. We'll take it. We'll take it. You guys can listen to some Charles Payne.
In over 40 years.
There we go.
You take out food and fuel. Remember, core was huge in the CPI. There's a growing camp that says we won't get back to 2% for many, many years, and that there's nothing the Fed can do about it. Your thoughts?
That's fair enough.
Yeah,
It's
I
kind of full
agree
on
with that. And here's why. Even if we take out food and fuel, food and energy, the reality is energy still impacts all of the other services that are in the other part of the CPI. Health services, watching children's services, all the services that we basically pay for require.
Okay, so I'll cut that off for a second. She didn't say anything wrong, or he didn't say anything wrong. But so Fed downgrades economic projections across the board. We just talked about that here. That's important. However, guys, they said they don't see themselves moving rates back down until 2024, 2025. That means we're going to have these high rates stuck with us for a while. I thought they may actually start doing it more in 2023, towards the end of 2023, as the recession times to get worse. Looks like they're not going to be doing that. They may allow the pain to continue on in this recession to kind of get worse and worse and worse as times go on. So keep an eye out for that one. That's not going to be good. But, okay, so if they're doing that way, so that means eventually, guys, hopefully sometime in 2023, maybe even 2024 if we're lucky, probably 2024 or 2022, we may have an opportunity for them to just reach the level they need to get to, and then they're going to stop. When they stop, that's going to be a very, very good time to buy a lot of assets out there, whether it's stocks, crypto, etc. The market may continue to move down, even after the good news of them not adding more rate hikes. But that's going to be a good opportunity where we're going to be close enough to the bottom where you guys could buy any of the assets you're looking for and not be too concerned that the market's going to really tank after that. Now, this isn't going to happen, this month, next month, anytime soon, I don't think. But you may see it happening closer to, sometime in 2023 if we're lucky, I guess, just because of how the economy is going at this point. I know it's right here. And hey, Christine, yeah, I logged at the dip early this morning. Oh, there you go. That's nice. What's right here? Yeah, no worries, Dynasty. Cool. We get 3 years before the Great Reset. Let's see. Well, guys, they're gonna probably change their mind quite a bit here, and even Fox Business is freezing on me now. Geez, why is all this stuff freezing? Let me see if I can go over here very fast. CNBC on this one. Maybe CNBC is working a little bit better now. Oh, I don't know what's going on. I think everything's getting overloaded as people are really trying to figure out what's going on in the marketplace. I mean, if it really comes down to it, they don't have Bloomberg. Bloomberg is something that usually works out fairly well. Oh well. Well, I'll try to figure it out, guys, because everything is freezing right now on my end. Let's see. Okay, I got the Fox Business back on. CNBC is like frozen, stuck. Sucks to be them. Let's see right here. There we go. Okay. We still got a few minutes, it looks like, until Jerome Powell comes out and talks. I don't know what time it was supposed to come out. I heard a few people say 11:15. I heard a few people say 11:30. I guess we're going off of 11:30 right now because he's already late by like 4 minutes. There we go. And let me see if this works out. There we go. Okay, I got 2 Fox businesses up just in case. CNBC seems to be screwed across the board here no matter what network I go to. That's fine. So here. And hey, Kilo, cowboy socks. There you go. What's right here? Okay, there we go, everybody. No, they're just talking to congressmen right now. All right. Whenever they bring Jerome Powell, I'll let you guys know. Let's take a little bit of a deeper look into some of these plays right now. Let's actually just open up this one right here for Bitcoin. Commercial. Oh no, they're talking about Ukraine, Russia stuff. All right. For now. Yeah, for now, let's not worry about it. Guys, at least for now, Bitcoin is still up on the day. We're not in the, we're not too much worse off than where we are before. What we saw was this big fake pump here. And what happened? Again, we got rejected from the 20-day moving average. It seems like that 20-day moving average is going to be a pain in the neck for the next few days. If we are going to have a reversal, it might happen sometime later on this week, sometime probably around like Friday or Saturday. But right now, that 20-day moving average is still creeping down on us. We had that death cross there. I think we have an opportunity to actually have a reversal here pretty soon, guys. Maybe a little bit more of an aggressive boost if we're lucky, but not as likely right now, right? So what do we got? Still got the support level around 17,622, but all of the other support levels, guys, they're all gone. We don't have any more of those support levels right now. They're kind of all just gone kaput, unfortunately. Let me go back over here to the second chart. There we go. Move right there. Yeah, we should be fine for now. Let's see. Let's see. And hey, Corinda, heading into work shortly. I only bought some fractional shares on Webull. Hopefully you're able to make some good money off of them. As long as you're making profit, you're looking pretty good. And let me see. Still no Jerome Powell. Gosh darn it. What do you call? Oh, Fed Reserve forecast rate hikes through the end of 2022. So hopefully if they stop around the end of the year, we may have a good opportunity to start buying up a lot more assets. And usually the market does like to run up towards the end of the year as the holiday season kind of peaks. Everybody wants to make more money. So everybody wants to have a nice bullish market for that to happen. Let me go over here very fast. Nothing there. Let me open this very fast as well. Then we're going to take another quick second look at these indexes. Oh, CNBC is back as well, so we can look at both of these here. Whichever one is usually working the best, I guess you would say. Finviz. The market definitely did not like those numbers here, guys. The market definitely did not like those numbers. Because you see everything from the Dow, NASDAQ, S&P all taking pretty big dips down here. You have some big gainers like Sling, it looks like. Oh, that's oil and gas. Of course, oil and gas is going up. But let me go over here to... let's just go to TA, I guess. Yeah, everything's pretty much going down today after that news. That's fine. But yeah, you guys can see it from the indexes right here. They really did not like that move. And of course, we were watching Bitcoin at the time, but everything is pretty much coming back down. You see the dollar index cooling off just a little bit. So let me go up to the 5-minute chart. Yeah. The NASDAQ, you can see it had a dump on the 5-minute chart right here. The SPY had a dump on the 5-minute chart. And the Dow all had big dips on the 5-minute charts here. So you saw those nasty moves going forward. Oh, well, we'll see if things can get a little bit better for us over the next few days, everybody. Okay, there we go. I'm in Europe. I love crashing euro. I have almost all my money in USD. Imagine how I'm enjoying it when I'm getting free euros. I mean, probably the best thing you can be doing. I've actually heard of people doing that over the past few months. This is not specific to Europe, but people around the world whose currencies are getting kind of hammered by the dollar, they've just switched a lot of their net wealth to dollars, paying a fee to do so for most people, and then they're just kind of waiting it out, and then they're earning out, they're making money just by switching their currency from the euro to dollar, and then when everything starts to stable back out, they're going to change it back for euros, and then they're going to be much better off for it. A good example of this here is if we move over to, do I have any of them on? Yeah, watch list. Okay, let's say you're in England, right? December. Let's just go over here to when things got really, January of this year. Let's say you did it when you saw the market start to crash. You saw the pound start to crash against the dollar somewhere around here. Let's just say right here from March. If you were to just moved your currency over to the American dollar, your currency is like, now you've made 15%. So if you transfer it back over to the euro, you're making 50%. You got to add on fees to that if you're doing larger amounts of money, though, which can be kind of risky. And the Fed says ongoing rate hikes increases are appropriate, and I guess they're correct about that. And hey, Shannon, anyone, why has Ethereum been dropping after the merge? This feels counterintuitive to me. Aren't the changes made good all around? It's because at the end of the day, Ethereum is an altcoin. It follows Bitcoin. Bitcoin leads the way. Bitcoin is the light for so many coins, and that includes Ethereum. And the Powell news conference starts in 5 minutes, 5 seconds. So it is actually 11:30 my time, maybe 2:30 your time if you're on the East Coast. Central states kind of vary depending on which time zone you're in. But yeah, Ethereum is not its own thing. It doesn't move independent of crypto. It follows what the market does. If Bitcoin goes up, Ethereum goes up. If Bitcoin goes down, Ethereum's going down. There's some minor times where it doesn't, do that exactly. But for the most part, if Bitcoin's going down, Ethereum's going down. If the stock market's going down, Bitcoin's going down. So it kind of all comes back down to the stock market at this point in time. There will be a time in the future where you guys will see that Ethereum, and Bitcoin and a lot of these other crypto assets decouple from this traditional stock markets, but it's probably not going to happen until the market bottoms out. And then from there, we're going to see some steady, some sideways moves. That's really where you guys are going to go buy heavy. And then from there, watch the moon kind of come out of nowhere. But, at the end of the day, it's an altcoin. It's not a business. It's not, it's a business, but it's not like it's not a stock. It's not going to get rewarded for good things happening to it, like an Apple might, or an Nvidia might, or AMD might, something like that. They don't get rewarded the same thing. Everything is built on Bitcoin when it comes to the crypto markets. Eventually, we all hope that crypto assets can move at their own pace, right? So maybe Bitcoin's having a rough time, but Ethereum is doing great. We all hope that day will come, but it doesn't look like it's going to happen anytime soon. And hey, Simon, discovered the power of options today. Let me just say I'm hooked. Congratulations. Glad you made some good profit. Make sure to put it in that trading journal and do it again sometime. And hey, what did they say? Crypto keeps on getting bad economic news past few weeks and still won't make new lows. I think the market participants don't care anymore. They just want to buy. See, how to explain this? In some part, you're right. The market just wants to buy. They don't want the market to be going down. That's true. But one of the reasons we haven't made new lows for crypto is just because the stock market hasn't made those new lows. A lot of times, depending on where you guys lean, you guys will use the SPY or the NASDAQ or some combination of both to see, hey, crypto likes to follow these two types of indexes. When we look at stuff like, not the dollar index, like the NASDAQ, right? This must be EMAs. No, SMAs? No, these are EMAs. Okay, hold on a second here. Let me go to EMAs. What's the history with EMAs actually with the death crosses or with the making breakdowns? So yeah, it doesn't mean as much here. Okay, so EMAs aren't nearly as important. All right, sorry guys, I'm keeping an eye out for Jerome Powell to come out and talk. But here, so let's go over here to NASDAQ. We're still waiting for the NASDAQ to actually break down below the 200 weekly moving average. This really like whenever we break down below the 200, that really starts the nasty move down, right? Nasty move down, nasty move down. That's where everything really starts to get bad as far as the NASDAQ is concerned. But again, we're still not at those lows. We're still not at those lows right now. If we somehow find a bottom out for the next few, until the end of the year, I mean, Bitcoin or the NASDAQ in theory can get all the way back up here to like $14,500. Now, is that likely? Maybe not, but I mean, we still have a pretty good shot of hitting it if we have one of these like really crazy bear market rallies like we just had over here. But, until the NASDAQ gets a little bit closer to the 200 weekly moving average, or it just flat out dumps below it, you're probably not going to see Bitcoin try to go too much lower. You might see Bitcoin go to 16,000, 15,000. But if you're expecting anything like 12, 10,000, 9,000, anything crazy like that, you're going to want to see the NASDAQ in particular drop down below this 200 weekly moving average here. Till that happens, we're kind of just moseying along, because you see the dollar index keeps on going up. I think as we talked about this over the past few weeks, what did we say? We're in this kind of general uptrend here. Let me see if I can pull this to you. I can't remember the last time we talked about this, but it's probably a week ago, maybe a couple of days ago. I don't know. But we have these nice dips in the market, but generally, guys, we're just continuing to go up here. We had a dip a few days ago, and look at that. It was a pretty good sized dip, but now we're back to going back up again. This is the cycle that we're going to be having for the next few months here. And, we just got to hope that somehow there's a longer term reversal where, we can get a rally out of Bitcoin before it eventually tries to continue going back up here. Now, after 2023 is over, after 2022 is over, we should find some type of high point for interest rates. And we should find some high for the dollar index. Now, that's a really good sign for crypto or other risk on assets if you want to go buying into them. However, then you just have to hope that the stock markets can all do very well, even though the recession that we're going to be in is going to be worse. So, here, hold on a second. Jerome Powell is talking. Oh, he's about to talk.
Good afternoon.
Good afternoon.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
They're selling off
I have
assets.
more to say about today's monetary policy actions after briefly reviewing economic developments.
This is
The
important.
U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate.
He sees the economy slowing fast.
Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%.
The market likes what he's saying.
Evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
There you go. He was a little bit too dovish for me, but it was fine.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular. To achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question.
So they're going to be raising interest rates, and then instead of just making them go down over time, they're going to keep them there for like a year, maybe two, and then go down as needed. It may take less time than that if the economy gets in really bad shape, but even if the economy is in really bad shape, they're not going to be doing it just yet. They're still going to wait even if the economy is in bad shape before lowering interest rates.
In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2%. Before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that, and that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was.
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll We'll just have to see how that goes. There is a possibility, certainly, that we would go to
A lot of stuff is pumping right now, guys. A lot of stuff is pumping.
Stay there for a time, but we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So
that's a good one.
So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also, do we get more labor supply, which would help as well.
Dow's up 300 points.
Chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2%, because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
If you guys haven't already, take a look at the markets. They're going crazy right now.
Not too long ago, in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about this sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply-side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply-side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
It's not doing too bad, everybody. He's giving some pretty dovish answers, more dovish than I would.
Is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024. And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
So it might not be till 2025 till inflation is under control. It doesn't mean it's going to take that long for the market to start ripping up
I
again.
wanted to ask about the balance sheet. You all
Hopefully.
have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future, and indeed, Treasury rates moved up, so we should have had a lot of tightening.
This is a great question.
Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
That's the dinger right there.
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So he's asking too many blunt questions.
I don't know what the odds are. I think that
I don't know.
There's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues.
He did not do a good job answering that question at all.
To get the policy rate up where it needs to be, and as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control, and that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it you know, down the road again, and doing it at a time when actually now people have really come to expect, you know, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN.
SEP stands for like employment pensions, maybe simple employment pensions.
Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, you know, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, you know, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, you know, that's a good thing. For the longer term, what we need is supply and demand to get better
Market's
aligned,
taking a little
so
bit of a
that housing
turn right
prices
now.
go up at a reasonable level, at a reasonable pace.
Dollar index
and
is
that,
spiking.
People can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where you know it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Good job, Christine. Getting out those longs. Yeah, it's taking a little bit of a dump now. Everything is.
Such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
You know, I think that shelter inflation is going to remain high for some time. You know, we're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think you know, hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory.
Just take one break here. We'll listen to her in a second. But basically, the Dow was up 300 points. Now it's down 100 points. So we're seeing some really massive swings right now, guys. Massive, massive swings.
Percent expected is that expected to be next year? How restrictive?
So I think if you look, you know, when we get to, let's assume we do get to that level, which I think is likely, you know, what you're going to do is you're going to adjust that for some forward looking measure of inflation. And, you know, that could be, you pick your measure. It could be, you know, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, you know, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Alrighty, that's it for that, guys. He was a little bit more dovish than I would have been. I don't think I really had any like big problems about what he was talking about. He was pretty straightforward. He got asked a couple hard questions. He really didn't answer those all too well, honestly. Like, how long should we expect this pain? You know, how bad could things get? What are the effects this is going to have, right? He kind of talked in bankalese, so like the language of bankers. Probably didn't come across too well if some regular Joe was watching it. If other bankers or hedge fund people were watching it, he did fine. Again, for me, he was a little too dovish. I think he should have been more hawkish as far as like, hey, this is going to happen. You know, even if data is coming in that says inflation is slowing, we're still going to be attacking it. Basically, you want to have that gauntlet kind of thrown down there, just because of, again, kind of reiterating what he said a little bit, but just in a different way, kind of using his words against him, if you will. July's number was surprisingly low. August's number was surprisingly high. And so he kind of talked about this a little bit as well. Is so you're not going to be using just one data point here for every rate hike. He's going to have to figure out a way to kind of convey that even if we have like 2 months of inflation coming down, it doesn't mean the fight is over. The market's going to assume the fight's over if we have like 2 or 3 months of like inflation coming down, even if it's not down by a lot. That's the type of mindset that they're going to have. Even though he said, or the report said that interest rates are going to stay high for like a year or so. If the economy starts looking worse, people believe he's going to be forced to lower rates ahead of time, leading to some uncertainty about what he's going to be doing. But that's positive uncertainty, not negative uncertainty. You want to have as much negative uncertainty as possible. But as you guys can see, it's been a pretty volatile day. We popped up a few percent, crashed a few percent, popped back up a few percent while I was talking. And that's the normal cycle of every time he comes out. If you guys ever traded Forex like I have, you make your bet right before he comes out. In this circumstance, you would have been shorting the euro or the pound. And then once he starts talking, or when he starts coming back out, you start to switch over from shorts to longs. And then some way through like part of his speech, you just say, hey, I've made enough money, and you kind of hop out. This happens with every single time, guys. Every single time they talk, you take your short. If you're doing, like the pound, you take your short, you sell it anywhere down here. It doesn't even matter where. You just sell it, take your profit, get a lot of pips out of it. And then from there, before he starts talking, which happened right here, see, it bounced back up. You take your long, you wait a little bit, then you take all that profit for yourself. Now we're probably going to be stabilizing into the close, which is another 45 minutes from now. After that, you should see a pretty volatile day tomorrow. With a 75 basis point rate hike, the market has actually priced a lot of this stuff in. So we could actually have a pretty positive day tomorrow or a pretty bad day tomorrow. We're not going to have that nice certainty. Like if it was 100 basis points, you know it would have been a very bad day tomorrow. Tomorrow is probably going to be negative like it normally is. But it's going to be a very volatile day all the same. So just be careful with it, okay, everybody? There's going to be some swings. You guys will get used to it. But right now, it was okay. It wasn't too bad. They still aiming for the 2% inflation goal. That's what you want to see. Inflation is not going to get back to normal for like a couple of years, guys. It's going to last a while. However, he's hoping that by keeping the inflation, by raising rates and keeping them high, demand will eventually slow. I think the problem with this, guys, is I don't know about you guys, but do you guys feel like you guys are spending more on a whole bunch of random stuff that you wouldn't have bought a few years ago? So, I bought a TV last year. I bought one TV. I didn't really go crazy with it. I bought a desk. I bought an office chair primarily for YouTube stuff. But, I'm not really, I don't know about you. Do you guys feel like you're just spending a lot more? Even going back to, after COVID and stuff, do you guys feel like you guys are ultimately spending a lot more? Because what I feel like is the root of all this, and what the big problem here, which the Fed cannot fix, they can only observe it, they can't fix it. It feels like we're worrying too much about demand and not enough about supply. I keep on hearing that, we need to get this into equilibrium. That's what Jerome Powell was saying. However, guys, I have to say, I feel like it's more of a supply issue than a demand issue. And if we can just get those up a little bit, I think we'd be much better off. And you guys know what it looks like when we have too much supply. We just talked about this earlier, like a week ago here. If I can go over to bestbuy.com, we're talking about NVIDIA graphics cards. I didn't spell graphics cards right, but that's okay. Why is everything capitalized? But NVIDIA GeForce RTX 390 Ti is $1,000, $1,100 when it's normally $2,000. It's a massive sale, right? 380 Ti It's down $300. Even that price is lower. I don't know what else we have here. 3080 gaming, only 10 gigabyte. Ick. But that's $739 instead of $999. You're seeing all these sales happen now because of too much supply going on in the marketplace, which is one of the reasons EVGA is no longer working with them. But my main point being here, guys, is it really gonna? I just don't see people slowing down their spending. If anybody's slowing down their spending, it's the people that make like less than $40,000 who are really getting hamstringed by inflation. But inflation is slowing down their spending, not rate hikes, if that makes sense. Have any of you guys felt like besides inflation, that you're spending less because of more credit card, higher credit card interest rates, and stuff like that? I don't think so. Maybe the housing market is cooling off. That's been working extremely well from the Fed's perspective, and I can't blame them for that. But that's something good because housing prices are getting pretty crazy. But come on now, guys. Have you really been buying? Like, have your habits changed so much that you're just buying so much more that demand is so out of control? I feel like this is almost like a false narrative that like we need supply to go up, not demand to go down, right? If we can have supply go up, wouldn't that be an amazing thing? I don't know what's stopping that from happening. I guess people would just say supply chain issues. But the more I think about this, I'm like, what does demand got to do? If there's demand for it, provide the supply and somebody will make a bunch of money. Why aren't people rushing off to try to make a lot of money by selling to people with all this high demand, apparently? It still confuses me a little bit. And again, I'm no economist. I took a few economy classes, but nothing like this detailed, right? Only some of the macro stuff and a few micro stuff, but that's all involving math, not real, real policies here. So I am interested to hear what you guys' thoughts are about this. And hey, Christy, I cut back on most of my spending. Hell no, I'm broke as F. Hardly even have food in the fridge nowadays. Jimmy, and hey, Christine, like clockwork, Powell looking hawkish. This is a course on manipulation of the people. They're politicians, they're bankers. They're very good at it. And hey, Keezy, I'm really confused about this point because I really want to ask like a professional banker what's going on here, because I feel like people are cutting back on their demand, but at the end of the day, if inflation is eating up all these wages, as everybody says, and which it is, like, is there a lack of pork out there? Why is bacon so much higher? There's a lack of labor out there. That's true. But I feel like, if we really wanted to do this in a very credible way that would piss off both sides, but make both sides ultimately like, hey, the bonds checks, the checking was better, the wallets were better. I mean, like, Biden's letting like 2 million immigrants so far this year. Teach them how to drive trucks, teach them how to do a lot of these other jobs, just enough so where like, the jobs are filled, but there's not too much competition, if that makes sense. They're going to find that fine balance. That's when most of the political sides are going to go, crashing into each other. But they need to fill up these jobs, like those jobs, supply chain jobs. I don't know about other jobs. That gets into more of what I don't know about because I'm not that involved in the economy, as you guys know, that type of stuff, or immigration. But, I'm so surprised how bad the supply chains really must be because, again, think about it. Are you really spending that much more? No, not really. I mean, I'm not. I mean, guys, there are months where I can spend like a couple grand on a trip or a few grand doing something really fun. But on average, last month, besides rent, I probably spent like $600 to $700 on stuff. A lot of that was gas, going out to dinners, having fun with friends, Loki's gifts, Loki's food, my food and groceries. I don't feel like I'm just like spending more than I was in the pandemic. In the pandemic, I was spending a lot more money because I had to keep myself happy because I was trapped in my apartment for weeks on end because everything was locked down. So I bought myself a new flat screen TV. I bought myself a new espresso machine because I couldn't go to Starbucks or go to the coffee shops. I spent money like freaking like thousands and thousands of dollars a month just buying the stupidest things to keep me entertained while I was at home. Hundreds of video games, lots of stuff to keep me entertained because, again, guys, I trade. It's not like I'm working from 9 to 5. I work for like maybe 3 hours, 4 hours a day trading. Some days maybe 8 to 8 hours if I'm doing like a long list of things like, hey, let's do some analysis and stuff like that. But normally I'm not doing that. So I was just really not doing anything except for just trying to pass the time. But yeah, I just feels a little bit off to me, and I want to dig deeper into this and figure out what's going on here. Let's see. Well, the reason I cut back on my spending, though, is to have money to put in the market. If I can stay profitable in the market like I am, I would spend more again. Yeah, I mean, that's fair enough. Let's see. A lot of stores are way oversupplied and marketing things down and laying people off. COVID is running rampant. Jobs aren't accepting COVID as a valid excuse for missing work anymore. That is true. I've heard about that quite a bit. Let's see. Oh yeah, energy is going to get worse as time goes on as well. Yeah, energy has definitely not been too good. I paid 700 euros for living as 12 square meter in Paris. It sucks. Oh yeah, I heard Paris is very, very expensive. Europe in general is a very, very expensive place to live. But you guys give a lot. Oh, market's taking a little bit more of a dump here lately, guys. There we go. NASDAQ is going down a lot more than Bitcoin is. You know, yeah, it's going to be rough for the next few months here, guys, as far as an economic standpoint. Hopefully it can get fixed up pretty soon. Hopefully we have a nice bottom at the end of 2023, or just in this year or next year, 2023. But yeah, we're definitely not looking at some great signs for the foreseeable future here. We can hope, but you know, if Jerome Powell keeps on trying to diminish demand, that is going to lead to more layoffs. I just don't understand what's stopping some supply from catching up. Because, you know, again, it's not like America is making all of these things. It's not like America is making the majority of the stuff you use. A lot of it's coming from India and China, which is why everything is just so weird to me that this is happening. You know, and with inflation, energy prices, housing costs, everything going up and getting more expensive, you know, because due to inflation. I mean, I just don't feel like the majority of people are just going crazy with these buying sprees. You know, if anything, I'm spending less than I guess I did a few years ago, but still, it feels so odd. Let's see, cutting back on my expenses so I can reach my crypto holding targets. That's a pretty good idea right there. I know a lot of people are doing that. Stuffing on eBay. Oh, Mr. Joker, hopefully you can find a better place to live then. That's not so pricey. But it's. I don't know how easy it is to move over in different countries, you know, versus Europe, versus England, versus America. Heck, different states have different rules, right? Over here in Washington, it's very, very easy to find another place to live, even though it might be a little expensive. And here it's Bitcoin taking that dip like the NASDAQ is right now. Let's see. But all the markets are down except for the Russell 2000, guys. Even the 10-year T-notes are actually down just a little bit as well. Let's see. Yeah. Import taxes are higher. Oh, yeah. Let's see. And hey, Tony, happy to see you back, my man. Let's kind of look right here. We've balanced back out. The market's actually tanking again here, guys. Only thing up right now that's kind of green I see is NVIDIA. That one's up quite a bit. It's up 3.5%. Probably had its own waves here. Do I have intraday? No, I don't pay for that. Well, I guess I have TradingView. But yeah, so intraday, NVIDIA is actually doing pretty well. A lot of other stuff is not, as you guys can see. Let me go back over to maps. Right, stuff like Verizon's down a little bit, Disney's down a little bit. Not crazy, but semiconductors are doing well. That sector in general is doing well. Financials are not doing well. That's mostly because the banking committees that were being held today. Airlines are not looking too good. Airlines are down like 2-3%. Farm and heavy machinery, Caterpillar down quite a bit. Let's see, basic materials not bad. PG, Procter & Gamble, that's not bad. It was PG. Oh, there it is. Only down. Okay, that's fine. Packaging is up a little bit. General Mills, oh, that's because they had great earnings. So that kind of helped out the entire sector today, it looks like. Entertainment's down a little bit. Live Nation, don't even know what that is, but it's down 3.5%. I never traded them before. Charter's going down, but they're having a Succession stuff going down. Okay. PayPal's up a little bit, but yeah, it's just, yeah. You see everything going back down after that nice little pop that we had a while ago. Let's see. Yeah, so far we're looking okay. See, this is why CNBC always makes me laugh. Look at this. Oh, he was doing technical analysis, and all he can do on that chart is just draw lines. There's not really much he can do. But yeah, it's going to be painful, guys, for the next few months. Let's see how everything kind of how everything works out, right? It's just going to be a little bit of a struggle. See, and hey, Jerky, yeah, COVID really messes up some stuff. I was talking to you guys about it, while typing, I guess, during Jerome Powell's speech, but I lost a large ability of my mouth to taste. I can't taste anything anymore, which really, really sucks. Like I was having cheesecake with my mother last night, and we were having it with some fancy berries I bought. I don't know what type of berries they were, but it was a good type of berry sauce. I couldn't even taste the berry sauce unless I put it all the way at the back of my tongue, and then I could taste it. I lost a lot of the tasting ability of me. So like everything I've been eating over the past few weeks, like I made some homemade lasagna. I made some fresh pie. I made corn dogs from Hillshire Farms, whatever it was. I had pizza from Papa Murphy's. Like I could taste it a little bit, but it's all like I can't taste it like I used to. It's really, really sad. But apparently the neurons are just kind of died or something like that. So I'm gonna have to develop a whole new way to taste. Apparently, sucks. But yeah, COVID can really affect the work. I'm lucky enough where I can kind of trade, so I can kind of work while sick, even though I don't. But I can run to my computer, work while sick, and nobody's gonna tell me not to work unless it's myself. Let's see. My nearest Walmart remodeled the store to make it larger than what it is. Extra shelving with overflow products, but nobody hardly buying the excess. I mean, again, guys, like who wants to buy right now knowing everything bad is happening? And the market's kind of already priced that in a little bit, though. A lot of people have priced in that the margins are going to be worse. Layoffs are coming, et cetera. And you guys remember, like a couple months ago when we were talking about all of this, what started to happen? Target said that they overbought and they were going to have to start running sales. I mean, we might be able to find that story here. Target sales. I probably have to go to news for this to happen. Let's see. No, this is all whatever. Target sales. Overstocked. There you go. Axios. 1 month ago, probably some from a while ago. We were talking about this for a while, but yeah, basically. Okay, there you go. See, so retailers need to mark down merchandise to clear excess inventory as they prepare for the important holiday shopping season, which for the third year is expecting to kick off early. A trend is starting in 2020. Trend started in 2020, right? So we saw holiday sales start earlier. So this is going to be a good time to buy stuff. Oh, geez, freaking spammers. However, if people keep on buying all this stuff, it's just going to be like perceived as, hey, earnings are really good. We can survive this. And then, when everybody doesn't, it's going to be bad. Let's see. Best excuse to start eating nasty, healthy food? I mean, it probably is. I mean, I shop at Whole Foods already. My friends think I'm already pretty bougie for doing that, but you know what? They have vegan granola bars that I really like. At least I used to like them. I don't know what they taste like anymore. But the taste was good, but they're also like $7 for like a pack of 6 granola bars, right? But yeah, I probably will switch up the food I eat a little bit. Not that I really eat really bad food now. At least the salads I eat don't taste like anything. I hate the taste of salad. I guess croutons are where the flavor is for salad. I don't put salad dressing on my salads because I don't like it. It doesn't taste. It's not that I don't like it, but it's where all the calories are. But yeah, it'll be interesting to see how this kind of new side of me takes over. Let's see. And hey, Irvin, guys, there's so much dating spam stuff on online. I can't even do much. Guys, if I even tweet nowadays, I get spam on my tweet, and I only have like 50 Twitter followers. That's it. And I get spam comments on me. Like, it's absolutely unbelievable, the spam comments. Like, I'm just like, dude, I don't even have like 50 followers. Maybe I do have 50, but like, not even 100 followers. Not really. It's not many, guys. It's not many. and I still get spam on my tweets. Like, it's just incredible how much spam is going up so fast, guys. So fast. Let me do one little check right here, everybody. Let's kind of zoom out. Let's go to the 1 hour charts and a lot of these things. You guys can see, I mean, we had that nice big pop, but we're definitely coming down in the short term right now. Let's look at some of these other indexes. The dollar index coming back up after that little bit of a crazy move that we saw earlier. The NASDAQ popping back up as well. These are hour charts, guys, hour charts. So we're kind of back to breaking even. SPY. Oh, SPY has come down a lot more than the NASDAQ. Geez, this is almost going to go to new session lows. Oh, we got a half an hour left. It probably won't do that. Oh, we got this nice support level here. That's why. Trend line. I guess it's something close to that. Yeah. SPY has some support. We'll be falling off a cliff tomorrow. Oh. All right, Dow's still coming back down the hour. Ethereum, wow. Yeah, this bad boy just tanked hard, didn't it? Doge is back up though a little bit. That's nice. So Doge is still up 1.5%, everybody. Ethereum is still up 1%. You're seeing stuff like ADA still looking okay. You know, going over here to the stock market now, a lot of stuff is more mixed. A lot of stuff is actually down. So you know, there you go. Let's go to hour chart. It's fine. What is this? Philip Morris. I have a lot of this stock. It's down only a little bit. Oh, it's actually up for the day, but down. You know, since the Federal Reserve meeting. LHX, good old military hardware. That's down quite a bit. Apple, trying to form a double top of some type, some really ugly double top. Maybe it looks more like it on the 2 hour chart. That's not going to be a double top. But we are going to be breaking down below the 20 here. That's not going to be good. So a lot of stocks look like they're set up to fall even more tomorrow. Netflix had a solid breakout. Just not the best breakout. It wasn't even solid. It was just okay. Tesla's down a little bit here. Let's go to daily charts. Oh yeah, Tesla's reaching a peak up here, isn't it? Might be okay to take some Tesla puts here, guys. Yeah. 2 weeks out probably would do the best and sell sometime. Oh, we're close to a death cross though. That's gonna be weird. But yeah, I'd still probably be buying puts here. When's the last time we had a golden cross? All the way over here. Oh, I wish we could have the good times from August. That is interesting that we're about to have a golden cross here between the 50 and the 200. Hasn't happened in a hot minute. Amazon didn't bounce off. It actually ended up breaking down over the past few days. MU going to new lows for the year. Oh man, yeah. So we really do have some bad actors here. Nvidia trying to bounce off. AMD found some support. So, you know, let's go to the hourly charts again. There you go. Yeah, you can definitely see that a lot of stuff just is giving up all those gains here. And you guys can see on CNBC, look at the sectors or the stocks. You can definitely tell a lot of stuff is just kind of going down there. So as the market finishes up here, guys, for the day, the stock market, we have another 23 minutes. You would expect things to calm down just a little bit. You might see more of an aggressive move going into tonight or tomorrow. Yes. But I think we should eventually cool off here just a little bit unless whales really have a plan. But when's the last time I was busy yesterday helping my sister, so I couldn't stream. But let's go to largest. Oh gosh, why do I can't? There you go. That's fine. Go to some of these larger Bitcoin wallets now. He still hasn't sold anything. This person still hasn't sold anything. So, you know, don't expect any big crashes anytime soon, at least from that perspective. Let's see. Hey, Christine. Yeah, there's definitely going to be tons of scammers out there for a long time to come. A long time to come. Let's go back over here towards, there you go. And you can see Bitcoin is continuing to come down here, guys. It is still getting slammed, unfortunately. Let's see. I'm still banking on that KuCoin interest-free coupon. Short positions reign supreme every time. It's still good for 2 more days unless they extend it again. It is interesting that it is pretty accurate there. Excuse me. So all the indexes are now down. Before the Russell 2K was still positive. Now it's gone back to being down negative here. You know, I think people are just kind of soaking in what he was talking about, and all the day traders that were in the market, whether that you're a person like a day trader like me who works from home, or a hedge fund day trader, we're all kind of exiting our positions and now just waiting to see how this all plays out. But but day traders are definitely getting on the market, and you're seeing a little bit of a sell-off right now because of it. Like, you know, last half an hour, Bitcoin's down about 3.5%. It was doing very well earlier. We're about to break back down below 19,000 and head in here to the $18,000 range. That's not going to be pleasant for anybody. Let's see. There you go. So yeah, so Bitcoin's about 58 bucks below now. Oh, there we go. Took us down to 19,000 or about, and now we'll see if we actually do get pushed down below that $19,000 level of support here. Let me make some moves over here. Not terrible, not terrible. But maybe we might be lucky enough to have some type of reversal, right? But just so you guys can see this very fast. Maybe you guys can, maybe you guys can't. Let me zoom in just a little bit here while Bitcoin maybe takes a little bit of a stop. All right, there we go. Look to the right hand side. You know, I mean, we're doing okay. Dollar index is up, of course, and NASDAQ is up a little bit. SPY and Dow are both down quite a bit. Ethereum is up, Doge is up, ADA is up, STMX is up. So a lot of assets are still up. ApeCoin's up still 7%. Lunacy is down 5%. Link is up 2%. So, you know, I mean, it's not great, but it's not terrible. You know, Spell Token's up 3%. UFO Coin, the I like, is up 3.5%, almost 4%. So let's back this up a little bit. There we go. Still in decent position as far as the crypto market's concerned. The stock market, not nearly as nice. You can see right now, we're clearly getting shorted back down here as far as the Bitcoin's concerned, but we should be able to find some type of bottom relatively soon. You know, short-term bottom. There we go. One green candle may be enough, hopefully. Got 4 minutes left though. Okay, but guys, we're not looking terrible. If we're lucky, we can find a bottom, and then we can just draw some type of trend line up like that and have some type of there you go. Have some type of pennant where we can break out of it later on or break down below it later on, so you guys can make a few quick day trades. But you should see the volatility slow down just a little bit over the next few minutes and going into hours. Okay. Let's see. Let me see what's going on. Okay, there we go. Okay, we're fine. Alrighty, but I'm gonna call it a day, everybody. I'll see you guys probably later on tonight. Probably a little bit later than normal. Probably sometime actually around 9 o'clock. I still gotta help take care of my sister because she's dealing with COVID. And I gotta take Loki outside. Loki hasn't been outside all day besides a couple bathroom breaks, so he's gonna have some fun. Loki. Oh, here, hold on. Loki, come on. You guys can say hi to Loki before I let you guys go. All right, there you go. Yeah, he just wants the treat. He just kind of runs off, doesn't he? Okay, but I'll see you guys later. Thank you guys so much for watching. Get ready for some increased volatility, guys. It's just going to happen. We've already had volatility, but it could get worse as time goes on. So just, you know, keep an eye on everything. The market's about to close here in about 18 minutes. Should open up Bitcoin to do some more fun stuff. I'd be paying much more attention to Bitcoin than I would be the market right now. Bitcoin's going to be much more volatile because we still got, like, you know, 4 hours left until the daily candle closes. We're going to be trying desperately to stay above, if I can find it right here, stay above this 2-to-1 Gann level right here. We're going to be fighting. We can break down below it, but we don't want to close down below it. We want to, you know, every time when the candle comes, we want to close. If we break down here, it turns into a level of resistance, and this is only a Fibonacci circle. A Fibonacci, a Gann level, much stronger. We don't want to break down below this, and we have a good chance of bouncing up. But the big push down, guys, is most likely going to come this weekend if it doesn't come before then, actually, I guess. But we're like so close to just completely dumping, guys. Like if this Sunday we close right here, next week is probably just going to be a flat out dump down to like 17,000s range. It's not going to be pretty. So a lot of what you guys are hoping for this week is literally just staying above this 2-to-1 Gann level, using the lows of 2020 as far as COVID's concerned. 2-to-1 Gann level, put it on your charts. It's important. I have a Gann chart for you guys to use down the road here. Oh, I guess I should have put my face off of it. Sorry, guys. We just want to stay above this 2 to 1 gain trend level. We could break down below it on the daily chart like we did here, here, and here. We don't want to close down below on the weekly chart, and we really don't want to close below it right here on the weekly chart. Okay, that spells the doom that I was just talking about a few seconds ago.